If you had invested $1,000 in Tesla in 2010, you'd have a portfolio of over $200,000 today. That's a 20,000% return, also known as a multi-bagger. This term, coined by Peter Lynch in his book One Up on Wall Street, refers to a stock which gives returns several times its cost to the investor. You only need a few of these investments in your lifetime to achieve an impressive track record and significantly outperform the market. That's why we have carefully analyzed multiple super investors to come up with a 4-part blueprint for you to follow in order to help you find such stocks. And it starts with part 1, correct market cap size. In his early investing days, Warren Buffett was not the billionaire we know him as today. He was dealing with a much smaller capital base and therefore focused a lot on smaller, undervalued companies. These companies were often overlooked due to their size, but Buffett saw this as an advantage. He understood that their lower market capitalization meant they had significant room to grow. The case of Geico, an insurance company, illustrates this well. In 1951, Buffett invested in Geico, which at that time was a relatively small and unknown entity. He recognized that their direct-to-consumer sales strategy kept costs low and profits high, and he also saw potential in the company's small market capitalization. Fast forward a few decades, and Geico has grown into one of the largest auto insurers in the US. The company's market cap has increased dramatically, as have Buffett's initial investments. Buffett's strategy and his experience with Geico demonstrate the potential of investing in small companies with room for growth. Instead of always going for the big, well-known companies, considering smaller entities with solid business models could yield significant returns. And that leads us on to part 2, economic moat. The concept of a competitive advantage, or economic moat as Warren Buffett likes to call it, is a key factor to consider when looking for multi-bagger investment opportunities. A competitive advantage can help protect a company from competitors and contribute to its long-term success. For instance, Buffett has consistently praised and invested in companies with strong brands, such as Coca-Cola. He first bought shares of Coca-Cola in 1988, and it quickly became one of his most profitable investments. Coca-Cola has a potent competitive advantage: its brand. The company's name is known worldwide, and its products are sold in every country except 2, North Korea and Cuba. This global recognition makes it incredibly difficult for new entrants to compete in the soft drink market. When Buffett invested in Coca-Cola, the company was already established, but its powerful brand name and global presence hinted at continued growth and profitability. Over time, Coca-Cola expanded into new markets and increased its product offerings, leading to significant returns for its investors. Buffett's investment in Coca-Cola underscores the value of investing in companies with a competitive advantage. These companies can use their strengths to fend off competitors and continue to grow, leading to long-term investment returns. When looking for companies to invest in, consider what sets them apart from their competitors. This could be a strong brand name, as in the case of Coca-Cola, or it could be a unique technology, a patented manufacturing process, or a dominant market share. A solid competitive advantage can be a strong indicator of a potential multi-bagger. And next we have part 3, twin engines. Twin engines refers to the idea of finding companies that have multiple strong growth drivers. Super investors like Philip Fisher often highlight the importance of this concept. Fisher, in his book Common Stocks and Uncommon Profits, advised investors to seek out companies with significant potential for growth in sales and profits, emphasizing the importance of both factors. A great illustration of this idea is Fisher's investment in Motorola. Fisher first bought Motorola's shares in the 1950s when it was a leader in radio and TV equipment. He was drawn to the company's commitment to research and development and its promising products in the growing field of communications. But Fisher didn't just stop at Motorola's current performance. He saw the twin engines of growth for the company, the potential in its existing businesses, and the new opportunities arising from its research in semiconductors. His bet on Motorola wasn't only on the company's present success, but also on its future potential. Fisher held on to his Motorola shares for many years, witnessing the company grow from a mid-sized business to a global leader in the communications and semiconductor industry. So when you're looking for multi-bagger stocks, don't just focus on one aspect of a company's performance. Look for twin engines, or multiple factors, that can propel the company's growth. These could include a mix of strong current sales, promising new products, expanding markets, or innovative strategies. A company that has multiple strong growth drivers is more likely to deliver high returns over the long term. And finally, part 4, the coffee can approach. The coffee can approach is inspired by the investment philosophy of Robert Kirby, a pioneer of the buy and hold investment strategy. This approach emphasizes the importance of patience and a long-term investment horizon in finding multi-bagger stocks. In the late 19th century, the Wild West investors would secure their valuable possessions in a coffee can and put it under their mattress. This was a rudimentary safe, and the possessions could be anything from money to stock certificates. It was not uncommon for these cans to be forgotten about and rediscovered years or even decades later, much more valuable than before. Kirby adopted this idea for his investment philosophy. In the 1980s, he advised a client to create a coffee can portfolio, buying a number of promising stocks and essentially forgetting about them for at least 10 years. The client did as suggested, but also continued to actively trade other stocks in their portfolio. Over a decade later, the value of the coffee can portfolio far exceeded the value of the actively traded portfolio, even though some stocks in the coffee can had gone bust. The massive gains from the successful stocks greatly outweighed the losses, leading to significant overall profit. The approach is about recognizing that the real significant value in stock markets is made by holding on to high-quality businesses over the long term, through thick and thin. This philosophy argues that to find a multi-bagger, you should look for solid companies with good long-term prospects, invest, and then do nothing. The hardest part is resisting the urge to intervene. It's about patience, not timing. For instance, if an investor had bought Amazon stocks in the early 2000s and held on to them despite the ups and downs, they would have seen their investment grow exponentially. And there you have it, a 4-step blueprint to finding multi-baggers. Make sure to subscribe and support the channel if you found this useful, and we'll see you in the next video. This is not financial advice and is just general strategies. It's important to tailor your investment approach based on your specific circumstances, financial goals, and risk tolerance. Always do your own research or consider consulting with a financial advisor before making investment decisions.